So today onwards we'll start with the standards on consolidation. Okay, so before we proceed with the consolidation, first we need to start with Ind AS 27. Okay, so there are a group of standards like Ind AS 27 is there. So we have got Ind AS 28, 27, 28, 103, 110. So these are all the standards which is related to the consolidation. So what does Ind AS 27 says? It is a separate financial statements. Now you need to understand certain distinction. Okay, so individual, we call it individual financial statement or standalone financial statement. Now what is the difference between a standalone financial statement and a separate financial statement? Both are same? No. See, when you don't have any subsidiary, when you don't have any associate, or when you don't have a joint venture, see these three entities, when you don't have, you have made investment in the equity shares of some other company, but that equity investment doesn't result into as influence, control, or a joint control, then you are going to account that investment as per Ind AS 109. So that financial statement, what you prepare, where Ind AS 109 accounted financial instruments are available, which is not debenture and all, equity instruments, you call it a individual or standalone financial statement. Clear now? Now you don't have any subsidiary. What if you have got a subsidiary? Or you have got associate or joint venture. That means you have invested in the shares and you got that influence. Your same financial statement, what the parent prepares, no, it is called a separate financial statement. But the distinction here is that investment is accounted as if it is not an associate, it is accounted as per Ind AS 109. But if it is an associate, joint venture, or subsidiary, it is accounted as per Ind AS 27. Now what does Ind AS 27 says? Ind AS 27 gives you two options. They say that you account this particular investment as per 109 or as per cost. Otherwise 109 will never say account as per cost. Equity investment 109 will give you only two options: FVTPL, default option, FVOCI. It will never say recorded cost. Amortization doesn't not applicable for equity instrument. But if that investment happens to be an associate, joint venture, or subsidiary, then you have got an option to value them at cost, which some other standard says. No, it is an option. If you don't want, you want value at 109 and take an option FVTPL or FVOCI. If you take this option, then this and this doesn't differ, same. But the moment you have opted for cost, then you cannot say it is a standalone, it is separate. And it is prepared by a parent. Now here, there is no requirement to prepare any consolidated financial statement. Do I have any requirement to prepare a consolidated statement here? No, I don't have any requirement to prepare. But here, along with the separate financial statement, I have to prepare consolidated financial statement, CFS. Now, what is that? There are in consolidation also there are two types of consolidations. One is consolidated financial statement as per 110. Now, when we prepare separate financial statement, when I have got a subsidiary, associate, or a joint venture, I need to prepare a consolidation. When I have got a subsidiary, I have to do 100% consolidation. That is governed by 110. That means, how do you prepare CFS? That is the question. See, first of all, you have to prepare standalone or separate. You can call it by any name. So if you don't have any subsidiaries, it's called standalone. If you have got a subsidiaries or associates, it's called separate. The difference between the two is, in separate you have got an option to value at cost. Along with this separate, you have to always prepare CFS. Now who told me to prepare CFS? Ind AS. Who told me to prepare CFS? As a company, I can say, no, I will not prepare CFS. Can I say that? Why? Which law has told? Schedule 3 has told. Companies Act told. Where? I studied, no? Enter section 128, books of account, section 129, financial statement. There it says that, look, if you have got a subsidiary or associate, they didn't tell joint venture, but associate includes joint venture, you have to present along with your separate financial statement, consolidated financial. If that law gets amended, then I need not apply this. Ind AS will never mandate. Ind AS will tell you the principles of accounting. Why? Because law cannot tell you that much depth. Then your Companies Act will become so much, this much voluminous if you start telling how to account also. That's why what they did in simple, they in section 133, they gave a reference of accounting standards. They say that, look, when you prepare financial statement, you prepare as per the what the government has told. And what government told? Have they come up with their own standard? No. Then one more edition, they said, till the time government will come with its own standard, which is not going to happen. Government has got so many headaches there. They will not design standard. The standards issued by the ICAI will be the something to be followed. Otherwise, see, Baba, who are we to follow our standards to these companies? Company will ask, no. It's like you are going and telling your neighbor, dictating the terms, do this, do that. Your neighbor will shout at you, who are you? Then what you do? You approach the parent of the neighbor and tell the parent, tell your kid like this. Now, this is company. Who is the parent of this company? This is a company. This is Institute of Chartered Accountant of India. If institute goes and tell, why company will listen? Company say, I'll do accounting on my style. Who are you to tell me? Then whom you approached? Now, who is the parent of this company? MCA, Ministry of Corporate Affairs. You approached them and they told, follow these people's standards. So standards will not mandate you. It cannot mandate you. It can give certain exemptions and all. So now, when you prepare subsidiary plus parent, you have to prepare as a single entity. That we are going to discuss in 110. And for 110, the starting point is 103, business combination. Without business combination, 110 doesn't come into picture only. 103 gives you the first financial consolidated balance sheet, from which the goodwill comes. And from then onwards, our 110 journey starts. Now, the last is the economic entity financial statement. See, look, if you already have got a subsidiary plus associate, the moment you have got subsidiary, you have to prepare 100% consolidated. You add associate also. Which method of accounting to be followed? Equity method of accounting, which we are going to learn now. But what if I don't have a subsidiary only? Still you have to prepare a consolidated balance sheet. It's not that if you don't have a subsidiary, you need not prepare, but that consolidated balance sheet is called economic entity balance sheet. In economic entity financial statement, you have got parent plus associate or joint venture only, no subsidiaries included there. And this is accounted as per Ind AS 28 in the consolidated. This is also CFS only. The difference between this CFS and this CFS, here investment may appear at cost, here investment will appear at the valuation as per Ind AS 28. Are you clear about this? The basic part? Perfect, no? Yes. Now, how do we prepare the consolidated balance sheets or financial statement? If you have got a subsidiary, you are going to do line by line consolidation, or I can call it 100% consolidation. We'll learn the rules. Previously in accounting standard, if you have got a joint venture, which method of consolidation you used to follow? You had a joint venture accounting, you have done that at Inter? Sorry? Pooling of interest method, that is an amalgamation when you have got a common control combinations. There is one method of accounting for joint ventures. Have you done that? Consolidation, joint venture consolidation. It is called a proportionate consolidation method. Like if you have got 50% interest, you will take only 50% of their asset. Followed, no? That's called a proportionate consolidation. Ind AS has scrapped that. They said no. For associate as well as joint venture, you have to follow one method called the equity method, which is governed by Ind AS 28. Now, an entity shall account the investment in the subsidiary, joint venture or associate where in your separate financial statement, not standalone. Standalone, which standard governs? 109. But in a separate, that means since you have got an investment, you can value at cost or 109. But you need to apply for each category. Like you can account all the subsidiary at cost, all associates at 109. That you can opt. But you can't do one subsidiary at cost, another subsidiary at 109. That you choose now what you want to do, but you have to apply it for a category. That is PP also, we have seen that. Revaluation, if you go, you have to go for entire class. Now, there is one exception to investment entities. An investment entity having investment in subsidiary need not consolidate, because in 110 we are going to learn there is one exemption given to investment entities. The logic behind it I will tell you in simple language to tell you right now. Investment entities like say for example LIC. LIC has invested in one company. What is their objective? Returns. Their objective is not to control the operations. That's why there is no fun in preparing consolidated balance sheet. Why your plant and machinery I will add and mine? Somebody will get confused. LIC's consolidated balance sheet, plant and machinery is coming. What you are going to do with that? That's why for investment entities, they have given one exemption, don't consolidate. In such case, they shall measure all the investment at FVTPL, both in SFS and CFS. That means no cost exemption. You have to account as per one, because your objective is fair value only, no. Investment in associate, you can elect for FVTPL in CFS or SFS, or you can go for equity method. Done. No, it's not its subsidiary. That it may consolidate. Suppose LIC has invested in Titan watch. It has taken one controlling stake, for example. But those things they have got an exemption. It may have its own subsidiaries, another investment entity, or it may have something which may give service, that they have to consolidate. Clear, no students? Yeah, this is all about your Ind AS 27. Let us look into some questions, some theory questions are there. Yes, let us look some one or two theory questions, because there is nothing much here, and these questions have never come in the exam also, in the previous syllabus. Just you can see. Following is the existing proposed group structure of original parent A Limited. Now, their existing structure is like this. There are some owners. We don't know who are they, individuals. They have invested 100% in A Limited, and A Limited has got two subsidiaries B and C. Now, what A Limited wants to do, they wanted to create one more company called a new company limited. And new company will hold 100% in A. And that structure is going to change like this. Why? Maybe to consolidate or something. They have got some legal ideas, structures. So this is the structure they want to create. Nothing. Instead of directly talking to A, they will talk to one new company. They may incorporate this in UK. Why? Because if they incorporate in UK or USA, they can get the funds from the local investment. Today, this A Limited is in India. Fund I have to raise in India only. What I will do if I establish a parent company in Mauritius? From there I can take the fund, give it to my subsidiaries, no. So this is one parent company, holding company. This may not have any operations as such. Operations will happen somewhere down the line. Now, as per the above structure, the owners of the company A will transfer all their shareholdings in A, these previous owners, to the new company in exchange of their shares. And new company will issue the equity shares to the owners. The same, no one. Previously, I was holding in the name of A. A, I will give it to new company. New company will give their shares to me. Ultimately, I am only controlling it. in the same ratio also they are going to give, so that they have the same absolute and relative interest in the net assets immediately before and after transaction. Assets and liabilities before and after is also the same. It's like a common control. The cost of investment in the company A in the books of owners is rupees 10 lakhs. So what they have done, they have invested in A 10 lakh rupees. Total equity of the company A, share capital and other equity attributable as per separate financial statement is restructuring is 15 lakhs. That means today its book value has become 15 lakhs. After the proposed restructuring, the new company wants to record the investment of company at the cost. New company wants to record. Now see what happened. They have invested rupees 10 lakh. This 10 lakh has turned into 15 lakhs. This 10 lakh cost worth they gave to them, and they took their shares. If you see, this is what? Notional, no? This is notional, right? New company is one name only for a namesake. Now, new company wants to record its investment at the cost. You have to record its investment in its separate. It will say, I have invested in company A. Now, new company will prepare SFS, CFS. Forget about CFS. They are going to prepare an SFS also. In SFS, they want to record at cost or 109. Question is, what is the cost of A? 10 lakhs or 15 lakhs? Understood the question? That's what. Somewhere, it's a very small thing, simple thing. It may come for exam. So now company is telling, so I want to record at cost. So question is, what is the cost of A now? Because new company has not incurred any cost on, if you talk about. Will they say that there is no zero cost, zero investment? No, they have issued their shares. No. Now what is the cost? The standard says your book value is your cost, not that originally what they have invested. So in the new company should measure the cost of investment at the book value which is shown in the separate statement of A. What they have shown in their books, no, that becomes your cost because it is a common control combination. So book value is like a pooling of interest method. So your answer is new company obtains the control by issuing its equity share. Did it pay the cash? Did it raise a loan from the bank and issued the cash to? No, it just issued its shares. Then the assets and liabilities immediately before and after remain the same. And owners have got the same. That's why your cost is nothing but your book value. So whatever book value was appearing in the book balance sheet of A, that is considered as the cost of my equity shares. Now, sorry, 10 lakh is what they have invested once upon a time. This 10 lakh is what they have invested in once upon a time. Now, they have given, what they have given? How much worth they have given? See, these people have given to them shares. Now, what is the value of the share? Simply like this, if a Reliance Industry gives me their company and say 36 chamber shares you give, I will also issue, no? For me what? Followed? No. That means it's a new company, Baba. It has nothing. It's just for a namesake there. Now, what is the cost of these shares? Nothing, no. But will they say nothing? No. So, since the ownership remains the same there, they have not issued to third party there, you have given your shares worth how much? When A Limited gave their shares, or we can say it's like a barter, you have to measure now fair value. Whose fair value can be measured now? New company share value can be measured, or what A gives, that can be measured. Oh, new company is only for namesake, no. What A can give, A will give the shares of A Limited, no. See, in A Limited today, in share certificate, whose name is there? Owner. Owner. Now, what they will do, they will give their shares to them. So going forward in A Limited, whose name will come? New. In new company share certificate, whose name will come? Owner is going to come. It's a share to share swap. Now, when they have got this, they will issue. They have invested in A now. What they have invested? That's the question. And this cost cannot be measured. That's why what owners gave them now, they gave this share. What is the value of this share? 10 lakh or 15 lakhs? 50, no, that's what they are trying to tell. Because you can't consider 10 lakh. 10 lakh is when at that time. Today, what is the fair value of this? 15 lakh. Why you didn't actually calculate the fair value? Why you? Because if you see, this is book value, it's not a fair value. In fact, fair value will be something different. For this, you have to go to A Limited, value individual property, land and all. You don't do this exercise because it's a common control combination. That's why whatever their book value was there in A Limited, that is the worth of the share. That gets transferred to you. If they would have given fair value, you should ignore that. Because it's a common combination. Book value will be taken as the cost of the issue of the shares. From where they will pay something? They don't have anything to pay something else. It's just a new company they created. No? It's only for the sake of book records, like legal structure. Yeah, later we will see how to understand this in business combination. There are beautiful concepts like reverse acquisition. Have you done? You see, you will wonder what is this. Okay. Now, question number 2. A company AB Limited holds investment in subsidiary associates. The moment it holds the investment in subsidiary and associates, its separate financial statement it's going to prepare, and AB want to elect to account investment in the subsidiary at cost and associate at FVTPL as per 109. Can they do that? Yes. Very good. That's it. See, now you have understood. The moment you read it, you understand it, what it is. Okay, this question may come, so you should write as per Ind AS 27. You have to prepare a separate financial statement when you have this, and you have got these options. But you should apply category wise. Category is not defined, but seems that subsidiary is definitely different from this. Again, in subsidiary also you can have subcategories like investment entity subsidiary, non-investment entity subsidiaries. There also you can give a separate breakup. Investment entity subsidiaries at a fair value, non-investment at cost, that also you can do it. Thus, in this given case, yes, you can carry subsidiary at cost and fair value. Now, PP Limited, one more question of RTP, because there is no, if you open the study material, only one question I think you will find, 1 or 2 questions. It's a very small chapter. But before we proceed, we should know what we are doing now in 103. PP is a non-investment entity, is the parent of Praja Limited. PP has got a Praja as a subsidiary. Within the meaning of 110, the investment in Praja was carried on the separate financial statement of PP Limited, because they are going to prepare SFS, they are going to prepare CFS at a fair value with the OCI. Can they do it? Yes. Why? Because they have got an option for cost or 109. 109 has given 2 options there. So you have taken it FVOCI. How beautifully it connects, no? Understanding now? Okay. Now, on 1st April 2012, PP qualifies as one of its investment entity. PP qualifies as one that is an investment entity. Carrying amount of the investment on 1st April 2012 was 8 lakh rupees. The fair value of the investment in Praja is 10 lakh on that day. PP Limited had recognized OCI an amount of 1 lakh as a previous fair value increase related to the investment of Praja Limited. That means it is an FVOCI, right? There is 1 lakh rupees accumulated balance is there. It has invested some money. Since it is doing one FVOCI, every year, what is the investment today value? 10 lakh. How much it had invested? Maybe 9 lakh. No. PP qualifies as investment. Carrying amount of the investment on 1st April 2012 was 8 lakhs. the question is very silent here. Which carrying amount they are talking? The fair value of the investment. No, they said only 1 lakh no here. And on 1st April was 8 lakh. The fair value of the investment of Praja on that day. PP Limited had recognized. PP Limited recognized the previous fair value increase. How would PP Limited account the investment Praja Limited on the date of change of the classification into investment entity? That means previously it was not an investment entity. So what it wish to do? Okay, we'll just understand, we'll see what they are trying to do. Now, see, previously it was not an investment entity, so it was doing CFS. The moment it becomes an investment entity, it has an option to take not to prepare CFS and do it as per FVOCI. And already it was there at FVOCI only. So now says that as per Ind AS 27, on the date of change, that is 1st April, the parent becoming an investment entity, its investment in Praja shall be at FVTPL in accordance with 109. So there you will not, because see, if it's an investment, if you are not an investment entity, then you are given that in separate you have got two options. But if you are not an investment entity, you will not never prepare CFS. Then it will become standalone. In the standalone also there is an option, but see, that option will override by Ind AS 27, no? Because you are given exemptions there. Otherwise, in reality, it is your subsidiary, but you are not opting that. Yeah, because see, okay, for this we have to come to Ind AS 110. 110 says that, look, if you are opting that I don't want to prepare a consolidation, then that must be, you must be doing it at FVTPL, no? Why you want to keep FVOCI again? Generally LIC. Do they want FVTPL or OCI? Investment entity always will take to P&L, no? Because they want to give to their shareholders. Will they like to take the fair value increase to their balance sheets? No. That's what the logic is. You should have valued at FVTPL. Investment entities, why on earth they will? See, FVOCI option is given for manufacturing entities who have got strategic investments and don't want to give that effect in the P&L. But investment entity, everything should go to P&L only, no? Logically. So the new carrying amount should be 10 lakh rupees now. Now, how this to be accounted? The difference between the carrying amount of the investment, okay. Now the question is something like this. Whenever they invested, they have invested at 7 lakh rupees. Then plus 1 lakh rupees OCI gain they recognized. That 1 lakh rupees OCI gain is sitting in the OCI. Now it became 8 lakh. On this day, the day they convert, their fair value was 10 lakhs. If at all it would have continued, then this OCI would have been got added with one more 2 lakh rupees. Because they will do FPOCI every period end, no. It would have got. But now, no, they are not done. So now they have to, that recycling they need to do. So when you got converted from your investment entity, like you took that exemption, the difference between the carrying amount of 8 and your fair value of 10 should be recognized in the P&L account. It is an FVTPL gain. Now what you have done, previously you have got 1 lakh rupees, no? So this should be treated as if you have disposed it off. That means transfer that to retained earnings. Don't bring into P&L now. Why? Because your original intention was not to bring into P&L. Further, the amount presented in OCI shall not be subsequently transferred to the P&L account. You shall not reclassify it. You have to transfer to one other component within the same equity. That means transfer to the retained earnings. Are you clear? Moreover, 107 is a disclosure standard. We are not going to talk about any disclosure standard because hardly 1 or 2 questions are there in your entire history of Ind AS exams. So let us focus more on the measurement problems. They say that disclose any of the transfers done so and so, so and so. Accordingly, they have to provide the below disclosures telling, so carrying amount is 10 lakh, amount recognized in the P&L is 2 lakhs. This is the disclosure you need to give. Are you clear about this? Okay.